Let me turn to my next guest, who is saying get ready for more bumpy days like today in the next 2 months. He's downgrading U.S. equities to underweight due to uncertainty about growth and policy. Andrew Sheets joins me now. He's chief cross-asset strategist at Morgan Stanley. Andrew, welcome. It's good to see you. What is the concern you see policy-wise?
Well, good. It's nice to be here with you. I think the concern is that I think markets are stuck a little bit between a rock and a hard place. In our base case, growth will improve as we go into the rest of the year, and that should push yields higher, especially as the Fed moves towards tapering. But I think you do have some real risks to the outlook on that growth side. We do think August data will be very weak when that data is reported in September in the US. And so I think that could also worry the market. So I think you have a market that is near the highs, has not derated like a lot of other equity markets year to date, and is stuck a little bit between the rate picture and the growth picture.
What do you mean it hasn't derated like others?
So we've seen valuations in a lot of other global equity markets come down quite a bit year to date. And we think that's normal. That's often what you see happen after a recession. You see markets run up quite strongly, and then what happens is that the earnings recover and the valuations come down, and those factors somewhat offset themselves. For the S&P 500, the valuations really haven't come down like they usually do when you get past that initial growth surge. And so that concerns us. The fact that you haven't had that usual adjustment yet makes us worried that it might still be to come.
Excuse me. So you're sort of seeing this as a lose-lose, if I'm reading this correctly, that, you know, if growth is fine, yields need to go higher. That could cause a correction. If growth slows, that causes a different kind of correction. Why wouldn't you look at this differently as a win-win, kind of the old Tepper trade where he says growth slows, the Fed responds, and we're already seeing that if they delay the taper. And if growth picks up, then it's, you know, how is this a lose-lose instead of a win-win for equities?
Well, look, it's the right question to ask because I think in a lot of situations for the U.S. equity market, it has been win-win. This has been an incredible performing market year to date, over the last year, over the last 10 years. So, I mean, this is not something we take lightly. I think these are real issues to consider. But I think what's different is, I think on the cyclical side, you know, this quite binary nature of the future of fiscal policy, that either our policy strategists think either you're going to get a large reconciliation and infrastructure bill or nothing. And so that is quite binary in a way that I think is unique. And then on the Federal Reserve side, the fact that you've already seen some major improvement in unemployment, the fact that inflation's already coming back, all those factors make us think the bar is very, very high for the Fed to delay a taper, let alone do more quantitative easing. So I think those factors are different enough that make us think that it's no longer that win-win situation.
And I know we've been talking big picture, but I actually want to rattle off a couple of the trades here that are your recommendations. These are kind of sophisticated, but for those who want to play this way, I just want to make a mention of it. So you're going, and this is the whole cross-asset team, you're saying go long Brazil equities versus MSCI emerging markets. I don't even know the second part of this, but I do understand when you say S&P 500 put spread collars, swap those for S&P 500 put spreads as implied volatility levels fall. You're closing your gas oil versus Brent, and you're adding 3-month puts on gold. Is there anything you want to correct there in how I explained it?
You got it quite right. So I think we think this is a difficult backdrop for gold because usually higher yields and a stronger U.S. dollar, which is what we expect, are not great for gold. If you look back to the last taper in 2013, 2014, gold did very poorly. We think Brazil is an attractive market. It's an equity market we're overweight. That is a market where valuations have adjusted a lot. Year to date, valuations are down almost 50% in PE. So I think that's a space where there is better value and more of these uncertainties is in the price.
All right, we will leave it there, Andrew. Thank you so much for your time today and a lot of different ideas for people. We appreciate it. Andrew Sheets is with Morgan Stanley.